If you're planning to sell your marketing or PR agency and your advisor told you to expect to pay an extra 3.8% tax, you might be about to overpay tens or hundreds of thousands of dollars. And the worst part of this is most agency owners never even question it. I'm Craig Cody, I'm a CPA, and I work exclusively with marketing and PR agency owners generating between $1 and $10 million in agency gross income. Today, I'm going to break down why the sale of your agency is often not subject to the net investment income tax, and why so many advisors get this completely wrong. The biggest mistake is treating your agency like a passive investment, and here's the problem. Most CPAs and advisors default to thinking business sale equals investment income, which equals the 3.8% net investment tax. And that's lazy thinking because your agency is not a stock portfolio. If you are actively involved in your business, managing clients, leading your team, overseeing delivery, you are materially participating, and that changes everything. So why does this matter? The net investment income tax generally applies to passive income, not an active business. So a practical example is you're running a 20-person agency, you're in client strategy calls, reviewing campaigns, managing leadership. This is not passive. The solution here is you need to clearly establish and document your material participation, because if you do, a large portion of your gain may avoid the 3.8% tax entirely. Asset allocation can also make or break your tax outcome. Here's where things get more nuanced and where most deals go wrong. When you sell your agency, the purchase price gets allocated across different asset classes: goodwill, client relationships, non-compete agreements, consulting agreements, and not all of these are treated the same. The mistake is letting the attorneys or generic advisors structure the deal without tax strategy. So why does it happen? Because they're focused on closing the deal, not optimizing your after-tax outcome. Real agency scenario is, let's say your deal is $5 million. If too much gets pushed into categories that trigger net investment tax, you can unnecessarily pay an extra $100,000 to $200,000. The solution? You need proactive tax planning before the deal is finalized, not after it. The way your deal is structured on paper directly impacts capital gains, ordinary income, exposure to net investment tax. This is where experienced agency-focused tax strategy matters. Ideally, you want this before the letter of intent. Your entity structure and your tax strategy drive the outcome. Another reason advisors get this wrong: they ignore how your business is structured. S-Corp versus partnership versus a C-Corp. Each has different implications when it comes to capital gains, active versus passive classification, net investment income. Tax exposure is the mistake. Thinking entity structure doesn't matter at exit. It absolutely does. An example: an agency owner operating as an S-Corp with strong compensation planning and active involvement can significantly reduce or eliminate the net investment tax exposure on a sale, but only if it's planned properly ahead of time. You should be thinking about your exit 12 to 24 months in advance. This gives you time to optimize your compensation, clean up your financials, structure ownership correctly, position income as active, not passive. This isn't something you fix the month before closing. So a quick question for you. Are you building your agency to sell in the next few years or planning to hold long term? Drop a comment below. I read them all. So the key takeaways, let's break this down. The 3.8% net investment income tax does not automatically apply to agency sales. If you're actively involved, your income may not be considered passive. Deal structure and asset allocation can significantly impact your tax bill. Your entity structure and long-term tax strategy play a critical role. And most importantly, this needs to be planned before the sale, not after. This is how smart agency owners keep more of what they've built. If you're even thinking about selling your agency in the next 1 to 3 years, this is not something you want to guess on. We help agency owners reduce taxes on exit, improve profitability before the sale, and position their business for maximum valuation. Click the link below to schedule a free consultation. Or if you're not ready yet, watch this next video, subscribe to our channel, because at the end of the day, it's not just about selling your agency, it's about keeping more of what you make. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.